So we'll get started straight away with the questions. How do you think demand supply dynamics have changed with the advent of green energy?
Okay, there are two impacts are in two buckets. One is where they were displacing the molecules directly, like biofuels. We have spoken about ethanol, biodiesel, HVO, renewable diesel, and the second is what we just spoke about, EV. So if you look at how they are actually impacting is on a scale of oil market, which is 103 million barrels per day, 103, 104 million barrels per day, 50% is what we are talking about. This is the road fuels. And out of this, if you look at the market size, for example, EV, if it goes to level of 5%, 10%, you will have a lot of its own supply chain problems, which you will have to tackle. And there is no solution at this point of time inside. The ones who are remaining in oil business or the fossil fuel business will have to move more towards the low carbon nature.
Moving on, geopolitical tensions are here to stay. I think we've sort of, factored that into existence now. But one of the unintended side effects of geopolitical tensions we've not seen as much earlier but are seeing now is how supply chains are changing. Not necessarily only trade flows, but supply chains themselves are fundamentally changing. So how much of that needs to get priced in, or how much of that needs to get factored into price risk management?
We have seen oil getting locked in the seas for longer times. So elongated logistics, ships having to reroute via the Cape, increasing freight costs, increasing insurance costs, the P&I cover for the vessel. Longer time oil remaining in the seas means preponement of the supplies. You're elongating your supply chains. And when you're elongating the supply chains, there is an additional risk on how do you manage the market structures, because backwardation gets further impacted if you have a prompt geopolitical tension. Regions of the globe having higher prices have continued to suffer higher prices, and those who are having lower prices, who could have helped them, continue to languish with getting lesser margins. So I think India has risen in the global platform to be able to sort of influence better diplomacy and to see that the world is much, much more peaceful in the days to come.
So I think, when we talk about energy risk management, refiners always spring to mind first. Seem to have a better hang on price risk management practices, but the real stress is actually felt at the consumption end. So what do you think consumer companies have done or need to do to at least come up the curve when it comes to price risk management practices?
For the end customer, first of all, knowing what is their risk is the first step, and what is their business model, and whether availability of those risk management tool is available really on the MCX platform or OTC market. Whatever risk they have, suppose for an airline company, if the volatility in the jet kero prices is one of the factor, whether they want to hedge jet kero or there is a availability on, say, MCX, only crude is available. So whether the product is really available on the MCX platform or not.
So Ashutosh, we've had regulatory guidelines that speak about offset hedging. There are guidelines that speak about price lock-in. How does that strategy change if you are a processor or a refiner and if you are a consumer industry like an airline? What fundamentally drives your decision to hedge?
There are three brackets: producer, consumer, and refiners. We are refiners. Frankly, refiners are not worried about whether crude is $40, $50, or $100. They are generally worried about what is the difference between final product and the crude price. As long as you get a good margin which is attractive to you, you are okay. Second point for refiners is on the refinery margin. That is where you need to take a view. Is $20 margin good for me? If you want to lock in at least certain percentage of that, then you go probably and lock in. You are giving up upside, but you also know that you are protecting some downside. But for a producer and a consumer, it's typically a one-way risk. So for a producer, They will be wanting to have highest price realization for their goods or material, whatever they produce. For a crude oil producer, they would want as price. So what happens when you look at your future, you try to lock in the price considering your cost of productions and all. Same with the consumer side. So in consumer side, typically airlines are very structural hedging. Typically west of Suez, the Western airlines, they have very structured plans of hedging in a stepwise manner for next 1.5 to 2 years. If you try to capture the lows and the highs, it never works in hedging. You need to be systematic. And plus that, you need to know what is your risk capacity. When I say risk capacity, what is the worst case scenario that you can withstand with? If you have these two sides, two things clearly in your side, I think you can have a very fairly good risk management program.
So I think, Mr. Saha, a bit of a paradox here, right? The hedging is required by the smaller players more than the larger players. The larger players should be able to ideally withstand volatility and price risk better. But unfortunately, the market makes it easier for the larger player to hedge than the smaller player. So how does one deal with the paradox? And the more blunt question, is it a market for small players as well?
We need to we need to develop this risk culture. So an appreciation of the risk that organizations are exposed to. They are not aware that price risks can actually impact their bottom lines to a large extent in case they are not able to pass on the prices. So we need to sort of educate them. MCX should take some sort of effort to sort of increase risk awareness and to make them aware as to what all tools are available. And when they are ready to actually come and hedge, then yes, MCX currently has only crude, apart from natural gas, has only crude. So for all the consumers of petroleum products, if they are residual fuels for burning in their DG sets, or for transportation fuels, mainly for diesel or ATF, jet fuels. The correlation between the residual fuels and the middle distillates with crude oil is quite high. For residual fuels, it's as high as 0.95, and for middle distillates, it hovers around 0.85 to 0.75. So they are reasonably well correlated. And in case small hedgers want to start hedging, I think they can start off with such high correlations. Of course, there would be some basis risk.
I think oil industry as such by nature is volatile. Given the condition, I think whatever best we can do is to employ the risk management activity at our end. Whatever small step we can take, step by step, with the active participation of MCX also and industry player like us also, to make you aware about those tools which can mitigate your risk and really make some volatility lesser for you. Even by a barrel, a cent or a dollar, it will help into your pockets.